So this goes back to your old work at a hedge fund, a little bit of what I'm doing right now. Can you point me to a couple metrics besides same-store sales that are useful when comparing restaurant stocks? I would say same-store sales, obviously the top line, but what's the component of it? I would obviously highlight traffic as the most important component, and then obviously moving down the P&L, restaurant level margins and operating margins for those that are more company-owned focus are the best things to look at.
Hey, on that, by the way, thank you so much for all of you that commented publicly on Twitter on the Real Vision discussion. It was actually the first time in 10 years that anybody in the media is giving me an open mic like that, and I'm genuinely grateful for that opportunity and sincerely thankful that you've been tweeting about it, because I think there's a lot of people that, at a bare minimum, want to be educated on a better way, and we're trying to do that. So on this education point, and again, this is, as I tried to articulate in the Real Vision interview, like everything that I do in macro is a function of what I did when I was like Shane. So when I was Shane, I was actually a retail analyst, a gaming and lodging analyst. I was a restaurant analyst. So I built same-store sales models. Okay, so when I talk about the base effects, or the 2-year base effect that matters in our predictive tracking algorithm for getting growth and inflation right against the top 20 countries, or any country for that matter, that we're measuring and mapping in GDP, really what I'm doing, and our analysts internally obviously know that, if I have a restaurant company, let's say I have Starbucks. Anybody hear about Starbucks in the last couple of days for any reason? I'm just wondering. Anyway, so you have Starbucks. So base effects are called comps, okay? Comparative base effect. This is what people on Wall Street call them. They say, what are the comps? Why is Howard Schultz no longer the CEO of Starbucks? Well, he has tough comps, doesn't he?
Tough comps and bigger aspirations.
Yeah, bigger aspirations, but you got tough comps. So again, it's harder to accelerate, for your business to accelerate, when the comps are tough. So that's the top line. Point number 2, let's actually just call that A. Point B is their margins, their EBIT comps. EBIT, earnings before interest and taxes, okay? Do they have tough margin comps? So again, when I think of sub this for, in the macro world, what I really have here is GDP, and here I have inflation, okay? Same model, rate of change, but the way that I came up with it was building company models. Okay, at the highest level, and doing quite well at it, I might add. Maybe I was on the right side of the cycle, but that's what it takes. Just like Howard Marks, I mean, he entered in distressed investing in 1988 at the perfect spot. We're all lucky in terms of where we're born into this market, and that's a really humble thing that you should always realize. So again, that was a really good answer, especially since everyone's talking about Starbucks these days. They actually have difficult comparisons, and we actually think here it's a short, don't we?
Yeah, they're running out of growth drivers, so they're depending on 6% unit growth, and now they're going to be delivering coffee after very little testing because they have nothing else that they can pull a lever on. So we don't think they have a shot. Coupled with management being...
Do you think that, since you said the number one thing for comps, so by the way, if you're looking at a restaurant company, getting all fired up, my old self in here doing the old model again, right? So if I take the comps, I got 2 things. I got my traffic, right, Shane?
Yep.
Then I have my price. Plus price.
Yep.
Now that's how I get my comp. It's my revenue. How many people come through the door and what are they spending when they come through the door? Bingo. So easy, Mucker can do it. This is actually why they gave me this sector. It's the easiest sector. It's just so easy. And then you can have all these qualitative views. Oh, I like the coffee. No, I don't like this experience. Whatever it is, I mean, that's kind of all the bullshit. But this is actually real important. Now, what do you think when you strap on old Howard here? And this is kind of ironic because our Shane's partner is Howard. We have Howard the Bear, they have Howard the Schultz. All right, here we go. What do you think Howard the Schultz is going to do to Starbucks traffic if he is even halfway successful running for the President of the United States against Trump? What do you think that Trump lovers are going to do at Starbucks? You think they're going to rush in and buy everything they can? Think that's a traffic catalyst?
No.
No. So I feel bad for the new CEO of Starbucks. I mean, that's a tough headwind to be walking.
So if traffic's at 0% now, where's it going to go?
Is it at 0?
Oh yeah.
Domestically?
Domestic. Yeah.
Oh my God! I thought that they'd have more because they have the bathrooms that anybody can go. Like it's just like a public bathroom.
Yeah, those people don't want $4 coffee.
No, it's like a homeless shelter.
Yeah,
and it's nice. Yeah. I mean, you can go there, you get free Wi-Fi, use the bathroom. Anyway, yeah. This is where Wall Street analysts really get paid. They get all these qualitative views like I just rattled off.
Yeah, and you get to talk about the food, channel checks. It is pretty easy.
Thanks for that. I had some fun with that.